There it is, the closing bell at the New York Stock Exchange. U.S. stocks tried bouncing back after the Bureau of Labor Statistics' latest consumer price index revealed inflation slowed for the first time since August. However, the rebound was short-lived. The Dow Jones ended the day in the red, down more than 300 points.
Yeah, the S&P and NASDAQ also had an up and down day. The S&P closed down more than 1.5%. The NASDAQ ended down more than 3%. Joining us now for more on all of this is Michael Rosen. He is the managing partner and chief investment officer of Angelus Investments. Michael, welcome. Great to have you with us. So what drove the markets down today, and how are the April consumer price numbers impacting investor strategies?
Well, thanks. It's nice to be with you. The inflation numbers were a disappointment today. Inflation was a lot higher than the market expected. And this led to concerns that the Fed is going to have to tighten a lot more aggressively than they've planned and that the market anticipates. And this also increases the risk of a recession in the near future as well. And so we see stocks falling a bit today. The yield curve flattened a little bit as well, again, expressing maybe some concerns of rising risks of recession and that the Fed really is going to have to be a lot more aggressive than they have said they're going to be.
Michael, how has inflation coupled with losses in the stock and bonds markets impacted the pensions of American workers?
Right. So for public pension funds and corporate pension funds that have defined benefit plans, inflation has had sort of a mixed impact, at least in the short term. The value of their stocks and bonds have fallen. That's bad. On the other hand, interest rates have risen, which serves to reduce the value of liabilities. And so the funded status for most pension funds actually may have improved a little bit with the rise in interest rates. But the real issue with inflation is it's just going to be very hard for pension beneficiaries and really investors everywhere to keep pace with inflation by owning just traditional stocks and bonds. Mm-hmm. Valuations are still relatively high. We're seeing prices fall and negative returns. But even if we had, positive returns, these returns on an after inflation basis are not very attractive. And so investors are having a really hard time keeping pace with the cost of living, particularly over the long term and even more so as inflation just continues. So the faster the Fed gets its act together and tightens monetary policy, the sooner we can see inflation starting to come down. But we're just not there yet.
And so, Michael, kind of to follow up on some of your earlier points, how would you suggest Americans whose pensions and retirement funds have taken a hit recuperate some of those losses, particularly if they are nearing retirement age?
Well, it's really tough. I wish I had an easy answer, something easy to do that would solve all the problems. But unfortunately, with inflation, it's very, very difficult to overcome for investors. I mean, no one's expecting inflation that we saw in double digits back in the 1970s. But if you think back to that time, investors in financial assets had a very, very hard decade. Certainly bonds had negative returns on an inflation-adjusted basis, and even stocks struggled again after inflation. So there's no real easy fix for what's happening until we get inflation under control. I do think that the best thing investors can do is to maybe pull in the sails a little bit and try to become a bit more defensive, shorten the duration. If you have long duration bonds, move to shorter duration bonds and take advantage of the rising interest rates. On the stock side, again, also shorten duration by maybe favoring companies that have solid and perhaps growing dividends. Higher dividends helps to provide some protection in a down market as well. But in the end, inflation is just a very, very tough thing to overcome for investors. But I think getting a little bit more defensive, maybe, again, shortening duration and fixed income and favoring higher dividend yielding stocks may be one way to lessen some of the pain.
All right. Breaking it all down for us, Michael Rosen. Thank you, Michael.
You bet. Thank you.